Good evening, unit holders of ESR-REIT. Thank you for joining us today at the SIAS-ESR-REIT virtual information session. We last met on 13th January to look into the proposed merger of ALOG and ESR-REIT by a trust scheme of arrangement. Thereafter, on 22nd of January, the scheme was revised following recommendation by proxy advisors that ALOG unit holders should have a better share of the benefits of the merger. In fact, we had a fire chat, Adrian.
Yes.
Under the revised scheme, consideration ALOG unit holders will now receive 0.97 in cash up from 0.095 and 1.7729 new ESR REIT units up from 1.6765 per ALOG unit. You unit holders will be eager to know how this revised scheme consideration affects you and your investments. What are some key developments over the last 5 months since the merger was first announced? So I have invited tonight Adrian Chui, Chief Executive Officer and Executive Director Manager of ESR REIT, to join us at this information session. And I would like Adrian to share with you some updates on this transaction, as well as to provide you with more relevant information. We will also address your questions. So please submit your questions via the Pigeonhole link sent to you for your email. We are doing this so that you can make an informed decision on the merger. So without further ado, I will now invite Adrian Chui to take us through the presentation to explain the transaction. Over to you, Adrian.
Thanks, Mr. Jera. Good evening, everyone. I will start off my presentation on the key benefits of the merger, followed by the details on the revised scheme consideration. On 15 October 2021, together with ARA Logos Logistics Trust, or ALOG in short, we jointly announced the merger of both REITs to form ESR Logos REIT, or ELOG in short. This is followed by a joint announcement on the 22nd of January on the revised scheme consideration. Under the revised terms, ESR REIT will pay 97 cents per ALOG unit to be satisfied by 90% stock and 10% cash combo. The issue price of ESR REIT will be 49.24 cents, resulting in an implied gross exchange ratio of 1.97 times. In addition, as per all REIT M&As, both ESR REIT and ALOG unit holders will receive permitted distributions from 1st of July to the day immediately before the date on which the scheme becomes effective. This merger will create a leading new economy and future-ready APAC S-REIT with transformational scale. Together, the merged entity will be renamed as ESR Logos REIT, or ELOG. And this is a strong and clear message that this transaction is a combination of two best-in-class management team and portfolio. ELOG will continue to be backed by ESR Group, our sponsor, who is the largest APAC real estate manager and a leader in the new economy real estate of logistics and high-specs industrial space, following the acquisition of ARA Asset Management by ESR Cayman, our sponsor. This will accelerate our portfolio pivot to the new economy assets of logistics and high-specs industrial buildings, which are suitable for data centers, life sciences, pharmaceuticals, advanced manufacturing production, and R&D activities. These resilient businesses have grown tremendously over the years. The enlarged REIT's total asset of 5.4 billion Sing dollars will be more diversified and resilient, has increased relevance to the business world with more competitive and wider access to capital. The enlarged REIT is well placed to create a future-ready, resilient portfolio with increased exposure to sustainable, in-demand, new economy assets such as logistics and high-spec properties, which has proven its resilience despite the pandemic and is also the largest circular growth trend in Asia. ELOG will have a superior combined operating platform and network, sponsored by ESR Group, which will become the most powerful new economy real estate platform in APAC as size increasingly matters. ELOG's growth trajectory given our access to our sponsors more than $59 billion worth of new economy pipeline, of which $2 billion is immediately actionable and available to us. The combined platform will have a strong ESG DNA as well to future-proof our portfolio and align with sustainability commitments of all stakeholders. More importantly, this proposed merger is value accretive for our unit holders. The logistics sector has continued to prove its resilience. In fact, the pandemic has further accelerated the logistics tailwinds propelled by the integrated value chain of production, delivery, and consumption. The enlarged REIT is well placed to capitalize on this trend. High-quality modern logistic real estate is increasingly critical to support the growing prevalence of e-commerce. At the same time, global manufacturing supply chain is undergoing a paradigm shift towards supply chain agility and increasingly local production. For manufacturing sector, it's no longer just-in-time manufacturing, but now it's called just-in-case. Looking ahead, we expect this sustainable demand for new economy assets to grow. The enlarged REIT will be underpinned by its core focus in new economy assets, accounting for 2/3 of the total portfolio. Our complementary new economy offerings are diverse and spanning from logistics to high-specs industrial to cold storage facilities. This provides multiple solutions for our expanded tenant network with integrated real estate solutions. ELOC will be well placed to serve strategic tenants across our network, including 3PLs, high-value manufacturers and operators, and cold storage users. We will have an increased strategic presence in Australia as it remains one of the core markets for ELOC since our maiden acquisition of a 10% interest in ESR Australia Logistics Partnership Portfolio, or EALP in short. On an enlarged basis, ELOC will have 61 properties within its network, 20 directly owned and 41 fund investments across key economic hubs such as New South Wales and Victoria. This strategic network is attractive to new and existing tenants looking for modernized real estate solutions. Strong underlying fundamentals of the Australian industrial and logistics sector have led to capital appreciation through the compression of cap rates in the fourth quarter of 2021. If you look at the industrial yields across the key cities such as Brisbane, Melbourne, and Sydney, the cap rates has fallen by about 100 to 130 basis points annually, reflecting a very strong demand for such assets in Australia. Size increasingly matters for REIT's growth and risk management perspective. On an enlarged scale, the REIT will enjoy a diversified portfolio exposure and increased presence in the attractive Australian logistics market. The increase in the number of single-tenanted buildings in Australia also enhances visibility in income growth due to the longer lease tenures and rental escalations. Importantly, the increased exposure to freehold properties and an extension of land lease expiry profile will further strengthen ELOC's portfolio quality. The enlarged REIT is expected to benefit from a combined pool of high-quality tenants, enhancing our tenant quality and diversification. With the enlarged base of 437 tenants across a wide range of industries, no single tenant will account for more than 4.6% of the REIT's gross rental income, or GRI, reducing tenant concentration risk. ELOC's top 10 tenants are expected to account for about 26.3% of GRI, down from 29.4%. This increases the defensiveness and resilience of our cash flows while we pursue our growth to deliver long-term sustainable returns for our unit holders. The enlarged platform will enhance our flexibility and ability to drive growth by providing operational synergies and portfolio optimization opportunities. Our 5.4 billion platform of 87 properties with 2.2 million square meters of net lettable area will now serve a combined 437 tenants. The enlarged scale also provides ELOC with great flexibility to manage our capital deployment and recycling through active portfolio reconstitution, as well as optimized leasing and property management. A key benefit of a large and liquid ELOC is the ability to achieve a more competitive cost of capital with access to wider pools of funding. ELOC will have a larger free float market cap, both in terms of total dollar value and percentage-wise, and we expect the enlarged REIT to enjoy greater representation on the FTSE EPRA Nareit Global Developed Index and other major indices. The increase in scale has proven to deliver significant benefits in the cost of capital. Since our merger with Viva Industrial Trust back in 2018, we have enjoyed lower cost of financing with lower loan margins, compressing at 59 bps to 1.4%, and lower cost of bond financing with bond interest compressing by close to 130 basis points to 2.6%. We have the intention to seek a credit rating for the REIT after the merger completes, which will put the enlarged REIT in a strong position to obtain a good investment grade rating. This merger is transformational in terms of scale and is expected to accelerate ELOC into a leading new economy and future-ready APAC REIT backed by our sponsor ESR Group. ELOC is expected to become among the top 10 largest S-REIT based on a free float market cap of 2.5 billion, improving its trading and visibility among the largest global funds. Today, ESR REIT and ELOC on a standalone basis are considered mid to small cap REITs. The merger of the two best-in-class REITs with a total asset size of 5.4 billion will propel us to rank among the large cap S-REITs and backed by a strong sponsor with an integrated business model across ownership, developer, operator, asset, and investment management of new economy assets. ELOC can also leverage on a sponsor's global tenant network, especially with leading e-commerce, 3PL, advanced manufacturing tenants, and data center operators to grow organically. The sponsor's strategic symbiotic relationship with these tenants provide insights into tenant expansion strategy, plus thus providing us a first mover advantage to grow and fill up our tenant base with blue chip names. With the support of our sponsor, ELOC will be able to leverage on the ESR Group's operating platform, financial strength, footprint, and network to accelerate our growth trajectory. With the robust demand for new economy assets, ESR Group has accelerated the rollout of its new economy strategy. The meaningful presence that ESR Group has assembled across 10 markets in APAC, which allows the enlarged REIT to leverage on the ground presence, de-risk entry into new markets, as well as access to tenant networks. Importantly, ESR REIT will have access to more than $59 billion of assets in an increasingly scarce environment for quality properties. For example, we have approximately $2 billion of visible and executable asset pipeline, both from the group and externally, in the short term that we can look to acquire as we look to supercharge ELOC's growth as the leading future-ready APAC REIT. ESR Group, with the completion of the acquisition of ARA Asset Management, will be the #1 real estate and real asset manager. The group will have the largest new economy AUM in APAC, with 1.8 times work-in-progress development deals larger than their closest peers in APAC, resulting in ESR Group becoming the largest S-REIT sponsor by AUM in Asia Pacific. ELOC is poised to benefit from the support of our sponsor to supercharge our growth. The enlarged REIT's development headroom will increase by 1.6 times, increasing our capacity to acquire more sizable assets and undertake larger AEIs and development projects. With a larger scale, ELOC will have a greater ability and flexibility to undertake newer large developments as well as redevelopments to drive value accretive growth, such as executing AEIs to unlock value from unutilized GFA and exploring opportunities to participate in co-development projects with our sponsor. Moreover, returns on these AEIs or developments can be enhanced with the enlarged REIT's access to lower cost of capital. Importantly, the proposed merger remains DPU accretive on a pro forma basis with the revised scheme consideration to ESR REIT unitholders by 4.7%. ESG is increasingly important for our operating DNA. ESR REIT has implemented various green initiatives such as ongoing solar harvesting programs with solar panels installed at 9 properties. We have partnered with the local communities to provide support for children and youth. We have also made our inaugural GRESB submissions for 2020, enhancing ESG disclosures. The ESR Group has accelerated ESG initiatives across its portfolio assets, building on the established success to lead ESG transformational in APAC. Similarly, ELOC will have reinforced commitment to ESG performance and continue to undertake green initiatives and include ESG as part of our operating DNA. ELOC will provide appropriate disclosures and commitments to achieving our green initiatives and have strong governance and embrace diversity in our workforce. As ESG issues have come to the fore with investors, we believe that together with the support of the ESR Group, we have made great progress in this area. We will be able to provide more robust ESG offerings. I shall now look at spend a bit of time to explain a bit of revised scheme consideration, Mr. Gerald.
Yeah.
This table provides a comparison of the original terms and the revised terms. The issue price represents a price to NAV of 1.22 times for ESR-REIT, while the revised scheme consideration for ALOC represents a price to book or price to NAV of 1.4 times. There is minimal increase in the total scheme consideration with a funding mix at 90% REIT units as well as 10% in cash. The implied gross exchange ratio is now 1.97 times, which is within the 1.948 times and 1.992 times based on the last close price, 1 month VWAP, 3 month VWAP, or 6 months VWAP of both REITs respectively. The merger is 4.7% DPU accretive with no increase in pro forma gearing. The revised issue price of 49.24 is in line with our unit price performance over the last 6 months up to October 14, 2021 at a trading range of 37.9 cents to 51 cents. The issue price premium ranges from 4.5% to 10.1% based on the various VWAP of 1 day, 1 month, 3 month, and 6 month as shown in the table on the left. The issue price, importantly, is also in line with the brokers and investment research houses' average target price consensus of about 49 cents. I'll take some time to explain the rationale for the revised scheme considerations.
Sure.
There are 3 reasons. First, the growth of ESR-REIT and ALOC are likely to be negatively impacted if conflicts of interest arising from between ESR-REIT and ALOC from a common sponsor is not resolved. With the completion of the ARA acquisition on the 20th of January, Mr. Gerald, the ESR Group is now an indirect majority controlling shareholder of ALOC's sponsor, the Logos Group. So the shareholding is actually 86.4%. It's not small. No, this means that the ESR-REIT and ALOC now share a common sponsor and have overlapping mandates, which will inevitably give rise to conflicts of interest and may negatively impact both REITs' growth potential. The second reason is the proxy advisor's initial non-favorable recommendation. Now, we take into account the views of the proxy advisors that the original terms of the scheme were not compelling for ALOC unit holders, and most of the benefits of the merger accrues to ESR-REIT unit holders. The revised scheme considerations provides a balance for both ALOC and ESR-REIT unit holders, as this merger requires the support of both sets of unit holders to be approved. Lastly, the continued strong underlying fundamentals of the Australian logistics and industrial sector provides both opportunities, diversification, and access to freehold and leasehold land to ESR-REIT. And these are the 3 key reasons why we decide to go with the revised scheme consideration. As mentioned in my previous slide, that the growth potential of both ESR-REIT and ALOC are likely to be negatively impacted if the conflicts of interest arising from the 2 REITs due to overlapping investment mandates and a common sponsor is not resolved. I will spend a bit more time because I would like to have our unit holders understand what is this so-called negative implication, right? Now, we have seen some influencers in the market commenting that both REITs can always remain on a standalone basis without a sponsor. But there are real and practical conflicts of interest issues and decisions which has to be resolved and answered, which affects the growth of ESR-REIT as well as to some extent ALOC. For example, if we continue to stay as separate, standalone, with a common sponsor, we will both be competing for the sponsor's asset pipeline. So which asset actually goes to which REIT? Even if we are able to jointly acquire the assets together, the question is, who has the majority? Right. Who is going to be the one that's driving the directions of the asset? So will the price that we sold to ESR-REIT more favorable than ALOC and vice versa? These are key questions you may ask, And if you need a sponsor's financial support for acquisition growth, for example, equity fundraising, ALOC may also need that as well. Then how will the sponsor decide how much money to allocate? Because they have limited resources. And you will recall that since ESR Cayman became the sponsor of ESR REIT back in 2017. They have provided full backstop of all of ESR REIT's preferential offering or rights issue, in short, to ensure that they save money on underwriting fees and there's certainty to the funding. This is very important, and that's how we can grow. Now with ALOG in the picture, is our sponsor going to split the financial resources 50-50, or what's the angle, right? Even for third-party acquisitions, not the sponsor, third-party acquisitions, we may be bidding against each other for the same asset, and we can end up paying more. Then after that, whoever is a winner, we'll go to our sponsor and ask for financial resources support. And even for third-party tenants, we will be competing to try to get them. In the end, the outcome is that we end up paying unnecessary money, more money, and get lousier terms. Does it benefit our respective unit holders? It could, yes, you can be the winner, but it can be a winner's curse as well, right? And there have also been comments that the board and management did not consider other options for resolving conflicts of interest. Of course we did. Now let me explain two options which should happen in the event that the merger is not approved, and importantly, the implications and the consequences of each option. To solve the conflict of interest, apart from the merger, the sponsor could either sell the ESR REIT or the ALOG manager. He doesn't need to sell the REIT. He just needs to sell the manager, one of us, and he can solve the conflicts of interest. That's the first option. The second option is he can divest either one of our REIT's underlying assets that are conflicting to each other. Let me go into more details in the slides for our unit holders. The share price performance of a REIT is highly correlated to the growth potential of the REIT. In turn, the growth potential of a REIT is highly dependent on the level of the sponsor's support, especially in terms of the assets pipeline and the financial resources support that the sponsor can give. This is a reason why strong developer sponsor-backed REITs tend to trade at a premium to its NAV. For example, ESR REIT trades at 1.2 times, while ALOG trades at 1.4 times. Now, in the event of either the sale of manager of one of the REITs, either REIT will potentially lose its halo effect, as its current premium to net asset value will be lost when ESR Group divests one of the REIT's manager. Why do I say that? Because there will be if once ESR divests one of the managers, there's no compelling reasons why the sponsor will continue to support this REIT in terms of asset pipeline as well as financial resources. The access to the 59 billion of new economy assets, the tenant, the operating network, and the financials will no longer be available to the once they sell off the manager. In addition, if the sponsor, for whatever reason, decide to sell off the ESR REIT manager, it will trigger a change in control provisions in ESR REIT's $1.2 billion of debt. And there is no guarantee that whoever is the new buyer of the manager will be able to get more favorable debt terms to refinance this 1.2 billion the debt. And the terms may not be more favorable. As you can see from the charts, a developer-sponsored industrial REIT and logistics REITs with large and clear asset pipelines tends to trade at a premium to NAV and lower cost of debt as compared to non-developer-sponsored industrial REITs. Now, I come to the second option, which is the asset sale of either of the REIT's underlying conflicting interests. Now, this is even more complicated. Unlike office, retail, and residential and hotels assets in Singapore, industrial assets sitting on JTC land face sale restrictions, as JTC must ensure that the buyers are qualified by them. Only end users of the property and companies with CMS licenses like REITs are allowed to purchase industrial properties sitting on JTC land. In addition, the new buyers will be subjected to non-sale moratoriums of 5 to 10 years, depending on the underlying land tenure of the property. Now, you will know that Singapore industrial land tenure are already very short, and you add the non-sale moratorium, the buyer is going to price that in, So the non-sale moratorium will actually further affect the sale price of the asset. As such, there is actually quite a limited buyer pool due to JTC's regulations, because they need to qualify the assets. So Mr. Gerald, if you have $100 million lying around, you can't just go and buy an industrial property and have investment property. You can't, because you are not an end user. Yeah. But you can go and buy an office building or a hotel. There's no buyer restrictions on that. So in addition to financing constraints may limit the purchase consideration offered by the potential acquirers of even some of the ESR-REIT's properties. We are already trading at a 20% premium to NAV. That means that any sale price that is less than a 20% premium to the asset valuation will mean value destruction for my REIT's NAV. And also, banks finance properties on valuation, not the purchase price. Hence, any buyer, even if they're willing to pay that 20% premium, will have to cough up more cash. I think we are, in local terms, it's called cash over valuation, and in the HDB market, we all know how it works. Right. So, and also importantly, I would like to highlight to unit holders that there are also non-sale moratoriums of certain assets in ESR-REIT's portfolio today. That means that we are actually unable to have a clean sale of all the conflicting assets with ALOC. Thus, the conflict still exists. I'll spend a bit more time next few slides to see how ESR Logos REIT will look like there's the merger as it's being approved. Unit holders, if you approve the merger, this is how ESR REIT, the enlarged ESR Logos REIT will look like. ELOC will continue to be managed by the ESR REIT manager with the best-in-class talents across both REIT and ALOC platforms. That means the staff will all come together. We will leverage on each other's strength. ESR Cayman and the Summit Group will each hold about 11.1% and 12.9% respectively in the enlarged REIT. Still a very, very substantial amount of alignment of interest with the unit holders. Now, 2 resolutions are being put up for unit holders' approval. The merger, as well as the proposed issue of new ESR units to ALOC unit holders as part of the consideration for the merger. Approval for each of these resolutions requires more than 50% of the total number of votes cast, and ESR Cayman Limited and its associates, the Summit Group, as well as Mitsui, are required to abstain from voting from these resolutions. So the above 2 resolutions are interconditional and are also conditional upon the scheme becoming effective. The IFA has opined that the merger is on the normal commercial terms and is not prejudicial to the interests of ESR REIT as well as its minority unit holders. Accordingly, they have advised the ARC and the recommending directors that the unit holders to vote in favor of the resolutions relating to the merger. In return, the ESR REIT recommending directors have considered the relevant factors and recommend that the independent ESR REIT unit holders vote in favor of Resolution 1, the ordinary resolution relating to the merger, as well as Resolution 2, the resolution relating to the proposed issue of new ESR units to ALOC units at the issue price of 49.24 cents as part of the consideration for the merger. ESR-REIT's EGM will be held on 21st of March at about 10 a.m. Once the resolutions are approved, the scheme is expected to become effective on the 22nd of April, with the delisting of ALOC expected to take place on the 5th of May. This is an indicative timetable. Unit holders, in conclusion, we believe in the key benefits of this transformational merger in creating a 5.4 billion new economy Asia-Pac REIT that is backed by a committed sponsor. There has been a paradigm shift in the way goods are produced, delivered, and consumed, driven by the rapid rise in e-commerce and further amplified by the paradigm shifts in global manufacturing supply chains. ELOC is well placed to benefit from the largest circular growth opportunity in APAC. Backed by the ESR Group, this proposed merger is expected to propel ELOC into the next stage of growth as we enjoy access to over $59 billion worth of new economy pipeline, of which $2 billion is immediately actionable and an increasingly scarce environment for quality properties. This merger will address the conflicts of interest of the 2 REITs with an overlapping investment mandate and a common sponsor. We should be leveraging on the sponsor's resources to accelerate the enlarged REIT's growth trajectory while solving conflicts of interest arising from a common sponsor. We shouldn't be splitting the resources. Whether from organic growth, acquisitions, and/or capital management perspective, with the merger, we expect the enlarged REIT to continue to deliver and create value for the unit holders. A larger, more diversified and resilient ELOC will have a clear growth trajectory given our ability to access wider and larger pools of funding at lower costs. The consequences of the merger not happening is likely to negatively impact the ESR REIT's value due to the standing conflicts of interest. Finally, even with the revised scheme considerations, the proposed merger is still DPU accretive on a pro forma basis. And with that, I conclude my presentation to you.
Thank you, Adrian.
Thanks.
You have sold your case quite convincingly, but unit holders will still have some areas of concern, which I will highlight.
Sure.
You never thought of doing law?
No.
You didn't want to be a lawyer.
No. I think I won't be too good a lawyer in that sense.
You submitted very well. So if I am the judge and listening to you, I want to bring to you certain concerns.
Yes.
And let me hear your submissions on them.
Sure.
Now, first for the benefit of the retirees and some people like me who don't understand new economy assets.
Okay.
Can you just simply explain?
Okay. Basically, new economy assets are logistics assets as well as high specs buildings. And these properties cater to what we call the up and coming industrialists who have been dominating the economy. Obviously, logistics asset, because of the pandemic, because of what is happening geopolitically around the world, supply chain and borders are being closed, logistics has become much more important. Obviously, e-commerce has even driven even more, especially since the pandemic has started. So logistics assets suddenly now becomes the flavor of the month because our style, the way we produce, the way we deliver goods, the way we manufacture goods have changed. Now, the high-specs industrial buildings today are actually very catered to data center operators, life sciences companies, advanced manufacturing, high-value add manufacturers, as well as pharmaceutical companies. These, again, are the up-and-coming industrialists that's going to new economy industrialists that's occupying occupying the economy right now.
The future.
Correct. The future of where we are going. So that is the reason why we call that a logistics as well as high-specs buildings that's able to cater to these industrialists, new economy assets.
Good. Now, Adrian, you did well for negotiating hard for ESR with this revised offer, right?
Yeah.
You gave the reasons why you did that.
Yes.
How do you assure ALOC unit holders that the revised offer is fair? Is there a possibility, some ask me, will Adrian and team revise? Because they bring to memory what happened in Viva. And they say that you were somewhat quite generous with Viva.
No.
Whereas you're not. One unit holder told me, why is he being a little stingy? Why can't he be like Viva? Now, the memory is about well placed on Viva, and you need to therefore tell them why is it so.
I think it's a fair question. I think the thing that I'm a bit more generous over as a Viva, I think there's misconception.
Yeah.
We always, whenever we look for fundraising, that when we do a merger, we will look at the current circumstances that we have. From my frank opinion, I believe that the important part is that when we look at the strategic rationale, what both managers can bring onto the table, and we discuss on that. And when I look at my revised offer price, especially my revised offer price, taking into consideration the feedback from the proxy advisors and taking into the fact that ALOC is trading at a premium and we're paying a premium over a premium, I think the other thing is we were able to bring in lower cost of debt to refinance the existing ALOC debt at a much cheaper rate, which results in even a better accretion to ALOC unit holders. When you take that into consideration, and then you look at the strategic rationale of what the two REITs, when they combine as one, could deliver, I believe that this is the offer that we give is actually compelling. We were not buying the assets. I think I need to highlight that we are not buying. It's not a sale. ALOC is not selling out. We are coming together as a merger. And even the proxy advisors actually agrees with the strategic rationale of the merger. I'm sure you read in the press over the weekend, what they said, and that it's supported by the strategic rationale is there. Even if you look at the press report that is when I think it's BT or said that even the Glass report says that actually the revised consideration represents a sufficient improvement in the value to A-Lock unit holders. Now, we recognize what they said initially. We shifted some of the benefits over to that. But I think even for my own ESR-REIT unit holders, I think my proposition today is we are still able to enjoy the benefits of the strategic rationale, access to freehold assets, and it's still 4.7% DPU accretive. There was a unit holder who did, when I first read the revise, an investor called me and said, hey, Adrian, you basically gave in. You capitulated. I said, no, I don't look at it that way. The benefits are still there. Yes, it used to be 5.4% DPU accretive. But now it's 4.7, but it's still 4.7. it's still accretive and money to be made. So I share with all unit holders, whether for A-Lock or ESR unit holders, I believe that this negotiation is hard. Karen negotiated hard, especially when we talked about the initial one and then the revised offer. Yes. So yeah, it's not something that we take it lightly. If you look at where the exchange ratio of 1.97 is actually within the range of a higher end of the range of where we are trading it.
Yeah, A-Lock is a price asset.
Yes.
It's a performing asset.
Yes.
So the cow is getting fatter now.
Yes.
Right?
Don't get me wrong. A-Lock has did very well.
Yes.
You know, obviously I do not take anything away from the management team and all.
They've done well.
They've done well, but obviously they had the tailwind, the logistics tailwind behind them. Whereas if we have some logistics, we can see it because we do have a logistics asset. It's just that we have 25%. Our logistics asset is 25%. So the tailwind from that is only less than 25% of the power, whereas theirs is a pure play. Yeah. So but don't take away. We don't take away the
dream here is that this big organization would deliver better value to unit holders. You did say that it will continue to deliver value to unit holders. Yes. So I'm a unit holder of ESR. Now I'm looking at A-Lock coming in. Will I get a better DPU?
Yes. Yeah, I think definitely the opportunity is there. I mean, first thing, you have a sponsors pipeline this for us. $59 billion, that's a lot, huge amount. I know I'm not tomorrow going to buy $59 billion, so unit holders don't get too shocked, about that. But now we are larger. We can do things faster and do things larger. 5.4 billion puts us into a new level, a new league.
You have a reputation for acquisitions.
Yes, I think we do. And I can explain why do that. I know a lot of people say, Adrian, all you do is just buy. You think that size matters. Size does matter. I truly believe size does matter, and size increasingly will matter.
Attract more capital.
Yes, exactly. And we have a track record of acquiring assets. We have a track record of acquiring well, but we also have a track record of running the operations well as well. So with this merger, with the continued backing of ESR Cayman, and ESR Cayman has become bigger. It's not as if ESR Cayman has stayed as it is, our sponsor said it is, and we became bigger. No, they have become even much bigger. Now they are like, right now having AUM of more than $100 billion. They are one of the top 3 real estate investors and fund managers we have seen in the market. So I think it augurs well for us in terms of the asset network, resources, and asset pipeline.
Conflict of interest has been one of the main concerns.
Yes.
Just propel ESR to actually decide to do this, because then you can manage, the sponsor can manage, common sponsor now. So since ESR came and completed the acquisition of ARA in January 2022, right?
Yes.
The conflict of interest between ESR-REIT and A-Lock has been the main narrative of this merger.
Yes, correct.
Right? However, ESR came and also has control of the manager of the other industrial S-REITs. So they asked me to ask you this question.
Okay.
Why can't ESR and Logos put up a Chinese wall between them and operate as 2 sponsors, since ESR is already doing it for Sabana REIT? How long will this stay?
Okay. I think there's fundamentally a bit of difference between within A-Lock as well as Sabana relative to us. If you look at it, A-Lock from day one already has a sponsor called Logos Group.
Yes.
They have been injecting assets, they've been supporting them. We, from day one, already have a sponsor called ESR Cayman, right? Also giving us. We have our sponsor pipeline with resources. I repeated that, right? Now, with ESR acquiring ARA Asset Management. The sponsor of ALOG is now, in a way, controlled, is 86% controlled by ESR Group. And as an 86% indirect controlling shareholder of the sponsor of ALOG, ESR has a lot of influence over the business directions, the assets, the strategic business angle, the financial resources of the Logos Group. This actually creates a conflict of interest. So imagine last time you have all your toys. Now somebody is controlling your toys. It's a very different proposition. Now, not to say that ESR Group is there to destroy the value of ALOG. No, because ALOG is trading very well. We are also trading decently well. Both of us are trading at premium to NAV. There must be a reason why we are both trading at a premium to NAV, because we have our respective sponsors, very clear partner assets, very clear sponsor support, and that is why we're trading at premium to NAV. So why not, instead of competing and having the conflict of interest, just come back together? Now, and it was very clear. I mean, in the case of I just noticed. I'm just watching it from the side. I can't comment on ESR's plans for Rationale for Sabana, because I'm not in the position to do that. But if you look at that, the history of Sabana, they were not. They don't really have a strong sponsor in that sense, like ESR came in. So the starting point is different, and then you can see. Even after ESR has become the sponsor of ESR, the asset injection is actually to us. That's why we got a 10% stake in the EALP, Australian partnership that we acquired last year. Yeah.
Of course, they follow up by asking, since there are also other industrial S-REITs under the same sponsor, why is this merger necessary at all?
I can't speak about other sponsor, but if I can infer what they were saying is possibly, excuse me, the fact that likes of the CapitaLand or the Maple Trees they have, but their sponsor are different. There's a sponsor, I cannot speak on their behalf, but what I can see as common differentiating factor is, although we have a common sponsor, but the REITs have different investment mandate.
Yes.
Some has hotel, some have office, some are logistics, and some are others. But and that is why there's the conflict of interest doesn't appear. But this one is different. Both ALOG and ESR-REIT, we have the same investment mandate. I can share with you those people who are in the industry, who are doing leasing, who are doing asset sales, will tell you the last 12 to 18 months, whenever there's an asset available for sale, there's always ESR and ALOG in it. And I would say 10 out of 10 times, the two finalists are the two of us.
Yep. So they are conscious of the fact that of the other S-REITs under the same sponsor, how will, in terms of competition, if this merger is successful, how will this set itself apart from the other industrial S-REITs? The same sponsor.
I think now if we come together, we have singular platform. The sponsor does not need to worry about the conflicts of interest. They can support us with the pipeline and resources. We have, and if you look at the sponsors' pipeline, these new economy assets are very good quality assets, and these are available to us. And obviously, and this is where we with a larger 5.4 billion, we are then able to acquire faster and larger, and the fact that we're able to access cheaper and wider pools of capital, it just gives our growth profile a much more good shot in the arm that we can actually grow faster and grow larger.
Yeah. So one area of concern is a decline in NAV. In financial year 2017, the REIT had a NAV of 59.3 cents per unit. In financial year 2018, NAV was 46.7 cents per unit, came down almost 12%.
Correct.
In financial year 2020, 40.5 cents per unit. And now from the unaudited financial year 2021, results NAV is 39.6 cents per unit. So the question is it the priority of ESR-REIT to grow by acquisition? All right, let's take a step back and look at REIT's strategy and its results over the past 5 years. If so, has it created value for unit holders? Also, has a REIT been sufficiently focused on operations and value creation through asset enhancement and asset management? So there's a group of unit holders who are thinking of this in these terms. So it appears that size is the main priority for manager. What about quality?
Okay. I think it's right. Since you take a step back, I also want to take a step back as well. When the ESR Group took over the then Cambridge Industrial Trust in 2017, it was a small cap REIT with assets under management only 1.5B, and this 1.5B over 40 properties.
Yes.
It's not a small cap, 1.5B, but it has 40 over properties. At that time, the REIT faced multiple challenges in capital and asset management. The cost of debt was high. It has a very concentrated debt expiry profile, and predominantly, and in terms of assets, they're predominantly single-tenanted and they're over-rented. And also, they are facing near-term lease expiries. And it also has a very heavily concentrated tenant. The top 10 tenants were accounting for close to 40% of all the rental income. So the risk was very high. In addition, the REIT's portfolio was made out of many, many small and dated industrial assets with very short land leases.
Yes.
Okay. And then we are also during then we were in a big oversupply situation, industrial space in Singapore. If you look at the data back then, we were in a huge oversupply situation. Even the logistics sector was a huge oversupply.
Right.
Now, during the moment we took that over, our communication to our shareholders and to the public was very simple. We need to clean up the REIT's portfolio through the following actions. First one, you need to overhaul the debt structure. Because as a REIT, we don't retain cash. If we are faced with pressure on debt refinancing, don't have access to debt, we have a problem. Finance 101 tells you that cash flow is king. So we have to overhaul the debt structure because it's very bad. We have to spread out the debt maturity profile. We have to make sure that the lower the debt cost, we have to unencumber our assets. So we did that. With the second, we have to divest the smaller non-core assets. When I took over, I have an asset that's worth $7 million. $7 million. It's so small that I don't know what to do. Some of these non-core assets, I don't know why it was being bought. I mean, I don't question that, but...
it was non-performing.
It was over-rented. I can't even do asset enhancements because the footprint is so small. So we have to actually get rid of some of these smaller and non-existent non-core assets. Now, then we take the money and execute AEIs. And redevelop or reposition the portfolio because the economy is changing. The fabric of the Singapore economy was changing. We were moving away from the disk drives manufacturing. You have big companies like Philips or whoever shifting out of Singapore. You need a higher value add. We need the new industries to come in. So we have to reposition, do AEIs on our asset. All this while we have to overhaul our debt, we have to get rid of all the smaller assets. And as well at the same time, we have to acquire in-demand assets because if you don't have in-demand assets in your portfolio, you will not be relevant. So we did that in the last 5 years. I mean, overall, if you see what you have today, our debt cost has tremendously come down. We are very flat. $1.2 billion of debt. No more than 400 million every year is expiring. We are 100% unencumbered. That means we do not mortgage our assets to borrow. We are able to issue PERPs.
Yes.
We are able to issue bonds. In August last year, I issued a $150 million bond at 2.6% for 5 years. When Cambridge did the 5-year bond issue of the 5-year bond in 2016, it was 3.95%. So I've overhauled it. Now, at the same time, AEIs, I've done a lot of AEIs. I've done 30 Marsiling, converted it from a general industrial building to a high-specs building. We have completed ESR Bispark. We have also complete 19 Tai Seng, a high-specs general industrial converted into high-specs, and it's now 76% committed occupancy. We have used the unutilized plot ratio and set up and built a 250,000 square feet of new space, high-spec space in 7,000 Ang Mo Kio. So overall, you see that we have overall reduced the overall risk and take out every stuff. But at the same time, why our NAV started to drop? It's because the land leases were short.
Land leases were
The
short.
land leases were short, getting shorter and shorter. So we lose
Yes.
value on the land leases. At the same time, when we sell some of the assets, we used it to deploy into the AEIs, which takes time to be completed, instead of buying back the shares.
Right.
So the number of units is still the same. The number of properties actually has been reduced. So the NAV, that's why the NAV has started to drop. But the most important, if you look at the whole holistic of the portfolio, has the REIT actually become more stable, less risky? I think the probably answer is, I would say yes. It's because even if we had not been less risky and less resilient, we would not be able to refinance our debt earlier and at cheaper rates and during a pandemic called COVID in 2020.
Yes.
And also because of the portfolio that has been more resilient that we created and we've done what we've done, we were able to rebound much faster out of COVID. Our results has just came out year on year for 2021 over 2020. Distributable income is up 15.4%.
It got vaccinations and booster as well.
Yeah, DPU is up 6.7%.
Yes.
So I would say that overall, because of that strategy, we were able to look at created value and make sure that the REITs actually has become, our REIT has become more resilient and able to weather the storm.
So it looks like, Adrian, you will maintain your focus on M&A since you stress the size is increasingly important. And it is also clear that the acquisition of ALOG will be an important step to bring the performance of the enlarged REIT up another notch.
Yes. I must say that the M&A size, my topic was 5 years ago, I told all the shareholders, size matters. It is, because if you're larger, you have more bargaining power from an operational perspective. You become a price setter instead of a price taker. At 1.5B, we were price takers, very clear. You know, whether for operational contracts, security contracts, we were price takers. Today, I wouldn't say that we're price setters, but I think we have better bargaining power. Size matters because you need to have large size. Then the banks, when they do the lending, they will be much cheaper. You have more bargaining power on the lending side. And you're able to access, if you're large enough, you're able to access the bond market and the perp market. Now, I'm sharing with unit holders now that size increasingly matters. Why? Because there are more and more large global fund managers, sovereign wealth funds. They are increasingly allocating money, more money, to smaller, fewer and larger vehicles. So we are all competing for more money that is being now allocated to smaller, fewer and larger REITs or larger vehicles. Correct. And that is the reason why you see that, Mr. Gerald, you see that even our peers are also merging or buying large portfolio of assets, right? I mean, there are some REITs, we merge is because we are in the same sector. We are in the same sector. We need to solve conflicts of interest, and we have a common sponsor. And there's clear operational synergies because we are in the same sector. But there are REITs like a totally different sector and coming in together. It's because the answer is they need size. Because if you're not on the radar screen of the global funds, you're not going to be able to take their money. If you're not able to take their money, you'll soon be a forgotten child. You've got to be included in the indices.
So if the merger is approved by unit holders, how do you integrate the two managers such that ALOG's operational and execution capabilities are magnified in the surviving manager?
Oh, of course. You know, you look at, as I said earlier, give credit where credit due. ALOG's management is very strong in managing logistics assets. So they have a very specialized skills and knowledge in managing logistics assets. On the other hand, we are better at managing diversified portfolio.
Yes.
Business parks, high specs, logistics, general industrial. We are also I would say that we're probably better a bit in our capital management strategy. How to manage our debt risk, access to capital, ensure that there's always a constant flow of funds into us, and making sure that when we do fundraising, we take care of our unit holders. If it's a good deal, it's accretive, we want to make sure that our shareholders are being taken care of. They have actually ability to subscribe. And then obviously they make money from that. So the combined team will be a combination of both parties. I will continue to be the REIT CEO. I'm
Group
probably
CEO.
Group CEO. I will be more, my skill set is more on the capital markets, strategic direction, strategic thinking and strategic direction.
Acquisitions.
Yes. Karen will join me as a deputy CEO. Her skill set is always on asset management, operations and all this, and she's very good at that. I think this management team will have a combination of complementary strengths of each other that we're coming in together.
Good. I think we got unit holders asking questions.
Okay.
Lai Yong Chang is asking, long stop date in the circular is 31st March 2022. Given that EGM will be held in 2 weeks, expected completion is April. Is there any intention to apply for an extension?
Yes. So, I mean, the unit holders are right. If you look at you definitely see the timetable. You're right. So, currently, the long stop date is actually 31st of March. We have and will intend to apply to the SIC, the regulators, to actually extend the long stop date beyond that. Yeah.
Next question is the REIT focusing on financial engineering, bigger is better, at the expense of operations? Example, impairments, negative rental reversion, low occupancy rates, make it full.
No, I don't think that is financial engineering. If we are focusing on financial engineering, I can share with you that we will be doing a lot of tricks like over-renting assets, single-tenanted, go and pay over-rented properties, or we will try to do deferred settlements and all this stuff. No, we don't do this for financial engineering. We have to make sure that the operations are done correctly. Whatever assets that we buy, there's no bells and whistles underneath, so that the properties are valued at it is, and not with some financial engineering over support.
Not at all. So management is, she's asking again, I think, management is selling the idea that ESR Logos will be a future-ready APAC REIT with AUM of 5.4 billion. Where does ESR Logos stand among its peers? Which segment has the most potential too?
I mean, we're at 5.4 billion. We're fairly large. I mean, in terms of our peers, we'll probably still be the top 5 or top 5 within the industrial REIT, and within the REIT space, we are probably the top 20 in terms of market cap and all. Then the question on which subsector will focus, it's basically high specs and logistics. These are the sectors that's up and coming. Yeah, what we call the new economy assets.
Yes. Now the next question is about geopolitical tensions. With all these wars going on and the trade war between China and America still there.
Still there.
So has the equation of this merger changed with the introduction of the current geopolitical tension? Chloe Tan is asking, as it stands right now, are we getting better or worse deal?
I share with you that right now, the global economy risk uncertainties have definitely spiked up. We are seeing inflation. We are definitely seeing inflation is coming, right? Energy prices is high. And 3 weeks ago, there's a new game changer.
Yes.
It is called the Special Military Operations of Russia into Ukraine. I can't say that word, okay? It has to be politically correct.
Correct, yeah.
This has resulted, what we see right now is the whole world has become more uncertain. The fact that I would say this is a better deal right now is because with a merger, with a larger combined 5.4 billion, you are better capable to withstand these uncertainties. Now, I can't, if you ask my frank opinion whether COVID-19 in 2020 was worse or today is worse, I can share with you both are just as bad. Because energy prices are up, inflation is up, there is not enough shortage of workers to execute what I want to execute in terms of AEIs. That's why I've been telling my investors, I may have to slow down on AEIs and redevelopment because I simply don't have the workers. And the cost of construction is so high that it just doesn't make sense for me to actually do the AEIs.
Well, GRI for logistics warehouse will increase from 15.6% to 45.3%. Are we putting too many eggs in one basket? Possibly the logistics tailwinds from COVID may not be that durable after all, says Mikey.
I don't think at 45.3% is too big. My personal opinion is that there has been a paradigm shift in the way we produce goods, deliver goods, as well as consume goods. E-commerce is here to stay. I don't disagree that the COVID-19 has accelerated the demand for logistics assets, but it's not going to suddenly collapse. I think the trends as well, how we consume goods, produce goods, and deliver goods, is going to have provide a sustainable demand for them.
Demand. Adrian, finally, if the merger is approved by unit holders,
Yes.
are you able to share some light on growth and business plan? Very, very succinctly. What can go wrong and what are the potential challenges ahead?
I think first part is important is that number one, we're going to be 5.4. We have access to sponsors' capital. The first thing I will do is I will accelerate some of the divestments of some of the smaller assets because it will take resources. And in a rising interest rate environment, in an inflationary environment, it may not be worthwhile to have those. So I will look at expenditure.
Yeah.
I will look at acquiring assets to make sure that I augment and make my REIT more relevant in terms of the product, in terms of what I can offer to my shareholders. Obviously, I would have said that the AEIs may have to slow down a while because the cost is just too high. I'm not afraid of the cost, Mr. Gerald. I'm afraid of the fact I cannot deliver the final product on time, such that I then have to compensate the tenant that's coming in because he has to change his machinery and fit out as well. So that is the danger that I can't deliver on time, right? Now, what can go wrong? What is the risk that I say, as I mentioned? The risk is what can go wrong is if unit holders do not approve the merger. If unit holders do not approve the merger, this conflict of interest is going to rear its head, and it is going to be very, very detrimental because we will be fighting with each other for the assets. So that one is the one that what can go wrong, and it's not and the other two options that I explained to unit holders about selling the manager and selling conflicting interest is really not in the interest of any of the unit holders. Now, what are the challenges ahead? As I said, inflationary pressures, more global uncertainties. But I think with a larger size portfolio, I think we should be able to manage that risk.
Right. Adrian, thank you very much.
Thank you very much.
You have answered all the questions we had for you today. So we need to remind unit holders that they need to vote. Note that the cutoff timing for the proxy form for the EGM is 10 a.m. on 18th March 2022, respectively. You can submit your proxy forms electronically via email. You've heard Adrian, yesterday the ALOC unit holders heard Karen. Yes. We fielded all the difficult questions, all the questions you wanted us to ask. It's been well answered. And now it's your turn to digest them and do what is best for you. Thank you for joining us.
Thank you very much.
Adrian,
Thank you, Gerald. Mr. Gerald, thank you very much. I appreciate it. Thank you.